Welcome to Policy Bazaar. I'm Arjun Bhagat. Now, the insurance sector in India opened the new year with a wide range of largely customer-friendly changes. The new rules, which came into effect on the 1st of January 2014, are going to impact virtually every sphere of the insurance policies and thereby affect us, the investors. Now, to understand them more comprehensively, we've got Yashish Dhaya with us, CEO and founder of Policy Bazaar. Yashish, tell me, what are these changes and the impact, I believe, investors in a positive manner?
Absolutely. These are very consumer-friendly changes which have happened. They are usually not very visible to the consumer because the consumer was not always aware of these. The first and most important change that has happened is for every insurance policy that is sold, life insurance policy that is sold, your sum assured, which was the actual insurance component, has gone up. So that used to earlier be 5 times. So if you invest 1 lakh rupees, you had to have 5 lakh rupees as your sum assured or your life cover. Now that has gone to 10 times.
These are non-linked plans.
These are non-linked guaranteed plans. The linked plans had already gone to 10x earlier. Now, if you are below 45, you have to take a sum assured of at least 10 times. If you are above 45, you can take a sum assured of up to 7 times. If you take a single premium plan, you have to take a sum assured of 1.25 times. So if you invest 10 lakh rupees, you get a sum assured of 12.5 lakhs. But if you are more than 45 years, you get a sum assured of 1.1 times. So some cognizance has been made for age, and the sum assureds have been increased to a reasonably higher level. So about 120 times monthly premium is now the minimum sum assured, right? Now the second part that has happened, and I think the biggest killer in the insurance sector, was surrender charges, and I think still continues to be. So by surrender charges, you used to lose pretty much 70% of everything you had invested plus the first year premium.
That's if you surrendered it before a certain time, before 5 years or 3 years.
Even if you surrendered it after time, there used to be very large surrender charges. Right. So those have come down. Now what has happened is, if you surrender a policy in the second or third year, then you would receive the same as before. So you would receive 70% of, you would lose 70% of the premiums paid plus the first year premium. However, if you surrender it in the fourth year onwards, that 70% loss would come down to 50%. So you will be guaranteed at least 50% of what you have paid if you wait for at least 4 years. If you wait for at least 7 years, you'll be guaranteed back at least 90% of what you have paid. So if you have paid, 7 premiums of 1 lakh rupees each, and 7 lakh rupees has been paid, you are guaranteed 6.3 lakhs. This was not the case earlier. So if you at least stay in a policy for 7 years, you will not lose money significantly. You will at least get your money back. So that's a consumer-friendly piece that has happened. The third piece that has happened is these policies have become a bit longer. So the minimum policy duration, the lock-in period, is at least 5 years. The minimum pay term is 5 years. Although you can have a single premium policy, but you can't have a policy where you pay for less than 5 years at a time. The fourth piece that has happened is something known as service tax. So earlier what used to happen was, LIC policies did not show the consumer a service tax component, whereas the private insurance policies used to specifically charge a service tax component to the consumers. Now the LIC policies also have to charge that service tax component. There is actually no change to the consumer in this because the companies were already paying the service tax.
That was already inbuilt to your
policy. It was already built in, but it was not showed separately. Now it is actually going to be showed separately on every premium. There is about 3.5% that you need to pay the first year premium and about 1.7% from the second year onwards. That goes as service charges into the government's kitty. Now, what all these changes do is they make the product tighter. In the sense, the product, all the hidden charges that were there in the product, or the hidden, a lot of companies used to make profits from people surrendering policies. Those have come down. And the real impact of this is actually the IRRs have come down a bit. So the actual return that consumers were getting has actually come down if you stay in the policy throughout the period. This is only for traditional policies. Remember, unit-linked policies were not part of this change to a large extent. Unit-linked policies were already, by the changes that happened in September 2010, they had already become fairly consumer-friendly.
So by unit-linked, you mean the market-linked policies?
The market-linked policies. Right. Now, a fifth very important change has happened. And this is, a lot of people used to ask us, why does, why is somebody else's mortality rate or somebody else's life insurance cost so much higher than somebody else's, right? So there has been, we used to use a table which was in force. It was called the mortality rate table, which was fairly old. If you looked at some press in the last few days, the mortality, the life expectancy in India has gone up by 5 years in just the last 10 years. So life expectation is really moving up very fast. And what that means is people's probability of dying at a particular age is reducing. And hence new mortality tables are there now. And everybody is now supposed to use the new mortality tables, not the old mortality tables.
And this is defined by our IRDA?
This is defined by IRDA. So what this means is the mortality charges, which are the charges that are paid. See, there are two kinds of charges, mortality and morbidity.
Right.
I know consumers need to understand these because eventually they're buying these policies.
Right, Yashish, you talked about unit-linked policies, basically market-linked plans. Elaborate on that, because even though the changes were brought about by the IRDA a couple of months back, but it's a process which is continuing in terms of the changes and making it more up-to-date, the entire insurance industry.
Let's understand on a macro level. ULIPs went through some groundbreaking changes in about October 2010. That's about 3.5 years ago. And when those changes happened, they became very, very consumer-friendly products. The commissions payable on ULIPs really shot down, and essentially the entire distribution community stopped promoting ULIPs in a big way. So they became a very small part of the business. However, the traditional products went through their set of changes very recently on the 1st of January. And with that, what has essentially happened is your sum assureds have gone up, your surrender charges have come down, the length of these policies have increased. There are new mortality rates. Mortality rates are the rates that companies are supposed to charge basis probability of death. So the probability of death that they are seeing is going to be lower now at any age because life expectancy is going up. Right. But everybody is now required to use the new tables, not the old ones. This should bring some of the cost of term insurance, etc. down. The other piece, while many companies had brought in term insurance plans which are very, very low cost, they were not using the same tables, the same rating tables for their traditional plans. Now the regulator has asked that similar charges should be applied on the other plans also. So some of those costs should come down. However, in principle, the returns on investment, so those investors who were investing from an investment perspective alone, the traditional products have become worse for them because the returns have actually come down compared to what they were
because of those
earlier.
Extra charges you talked about.
No, because of the transparency is forcing companies, the companies cannot make as much profit from surrender charges any longer.
Right. So and that was a huge component. That's something that you talked about earlier.
And of course, nobody would like to speak about it, but the fact is there were a lot of charges from surrender charges, and that is something that has gone away. So that money has to be made from somewhere else.
So that's a positive move in terms of the rights of
absolutely
consumers.
The consumer, it's a transparent move, and I think so these are very, very favorable guidelines, but they make the product more transparent. Now the problem with the traditional products is the more transparent you make them, the more the consumer can see, and the more the consumer realizes they're not really consumer friendly. So that is a fundamental problem that is there. Of course, they have advantages of somebody, but not from an investment perspective. They are very good products from an insurance perspective. They become much better at that. But from an investment perspective alone, where the customer is saying, give me an IRR or give me a return on my investment, they are starting to become poor products. So traditional products, long term, are starting to become a poor product.
So there's this huge churn, you're saying, which is going on in terms of the policies which were offered before 31st December and now. So how have companies adapted to it? And also, are there policies which have been discontinued? Because, you know, we identify a lot of policies with LIC and others who have brought in. Have they been discontinued? Have new ones been introduced?
Some of the very, very popular plans like a Jeevan Anand, the Jeevan Saral, these went out of circulation on the 1st of January. And of course, new policies have been brought in. Some companies were very proactive and started aligning their policies much earlier to the new guidelines. So one particular example out there is Aviva, which has got 13 policies already approved. So a lot of companies are getting their policies approved, and IRDA has done a brilliant job. You know, IRDA is usually put in a corner that, you know, you're not approving products fast enough, etc. They have approved roughly about 500 products in this time zone. Remember, there are 30-40 insurance companies, so there's a huge amount of products that have been approved and, you know, put out there with the new guidelines. Companies are still figuring out, because remember, it's not just a product. It's now about training. It's about how the product is supposed to be sold, how the product is supposed to be pitched, how the consumers are going to. So there's a lot of preparedness required, which is getting underway. But yes, I think it's a change that's good for the consumer.
Right. So, before we go in for a break, let's just reiterate for us, what are some of the ways a consumer can get that right policy in this entirely changed scenario as far as insurance is concerned?
A consumer has to decide what he wants. If he wants to make an investment and earn returns on it, traditional insurance plans are most likely not the answer for him. Most likely. If he is looking for insurance, then traditional products have become much better. The unit-linked plans are actually very favorable to him, and some of them even beat mutual funds on cost. And that is the macro piece that the consumer must keep at the back of his mind. If anybody is telling you 10% guaranteed return, 11% guaranteed return,
that's not going to happen. That's
the other piece that has happened, which is very, very sound, is that now the returns have to be shown at a 4 and 8% maximum possible IRR. So no traditional plan in the market can promise you a return higher than 8%.
It's the same as your PPF gets you, or the National Savings Certificates get you around.
I think it is lower.
It's lower than that.
It's lower than that, although there's some tax components to it. But you would certainly not, from a financial investment perspective, you would not find it very favorable to invest in traditional plans. You would find it favorable to invest in unit-linked plans. And you would find it, however, from a risk perspective, risk mitigation perspective, remember, nobody gives you a 30-year FD.
Right.
These products do guarantee you returns for 30 years, 40 years, and that is where they really start having their strength. So if you have a long-term view and you want that long-term protection, then they are very, very helpful. But buy it for the right reasons. One can't say there is one particular reason why this plan is good, so let's sell it for all the wrong reasons.
Right. Okay, Yashish, that's all the time that we have on this segment. But do write to us. We're going to take your questions after this, of course. Do write to us and ask@policybazaar.com. Tweet us. Welcome back to Policy Bazaar. I'm Arjun Bhagat, and with me is Yashish Dhaya, who will answer your questions. We've got Pankaj Lal from Ludhiana with us. He's written, he says, I'm a retired bank officer and have two questions. I wish to give a policy having a combination of insurance and investment to my granddaughter, aged about 14 months, for a period of 20 years with an annual premium of about 20,000 rupees. Her father is 38 years old and the mother is 32. My granddaughter is a US citizen living with her parents. They're both NRIs since 2006. Yashish.
There are two options here. One is, I'm assuming, well, although the gentleman has not provided his age, I'm assuming that if his son is 38, the gentleman is about 68. About 30 years gap is what I'm assuming as a normal. So he could take a plan in his name and make his granddaughter the nominee. However, that'll be very difficult because at 75 he will have to exit from most plans. So there's very little time left for that. The alternative is he takes the plan in his daughter's name and in his granddaughter's name and makes one of the parents the nominee. That's again strange because then the insurance component he'll be taking will be on the grandparent. So is tax an important element for him? If tax is not an important element for him, what he could even do is buy these plans in the name of one of the parents, right, and make the grandchild the nominee. And that would work phenomenally well. There are lots of plans out there. ICICI Prudential has some, HDFC has some, Aviva has some. Look at the child plans. Or alternatively, just go and invest in a straight ULIP. iGrowth is there from Aviva. It's a pretty strong returns ULIP. Just invest in that for a period of 20 years. The highest possible corpus building will happen, and also the sum assured will be protected from day one. So there are advantages there. That's what I would advise. I don't think a lot of plans will have this position where the grandparent should take the plan in his name. That will not work from an aging perspective, and the child getting a cover for the child makes no sense.
Right. Right, we've got Kishore Gupta from Jodhpur. He says, I have an ICICI term plan cover for 50 lakhs. He pays a premium of 8,876 rupees. I took this policy 2 years back, and now I came to know that HDFC Click to Protect is offering a 1 crore cover for the same amount. So, I mean, that's a recurring theme with, new products come in and you find that, you want to change the older one. So, I mean, I
think it's a great phase we are going through. The last 3 to 4 years have been great, whether you look at health insurance, whether you look at term insurance. And we are very proud, we are very proud that we are part of this revolution and driving this revolution to a large extent. That, protection-based products really keep coming out one after another. And what happens is every company is outdoing the other in terms of price, innovation, product features. You've now got Aviva and Max Life who have come out with deferred term plans. So, of course, as options come in, the benefit is to the consumer. Remember, all of this benefits the consumer eventually.
Right.
And hence the consumer should take advantage of those. The term insurance policy is a policy where you can move from one to the other anytime. There's no issue whatsoever. And the premiums have been coming down. So, my advice is make use of the options, see what's good for you. However, do not ever give up your old plan till you have got the new one. Right, because just in case you fail the medical, you don't have a situation where you've got...
And that goes for health insurance policies as well.
For any protection.
Right.
Remember, for all these protection plans, you are the individual at risk. If something has changed about you, which implies, or something is there about you which will not get you the cover, and you already have a cover, you're in a very strong position. Please retain that position. Do not give it up and take another plan. So that's my advice. But I think it's hugely consumer friendly. The consumer should be very happy about the situation.
Right. We've got Shankar Dhawal from Visakhapatnam. He says he's 22 years old. He's a student. My father's taken a LIC Jeevan Anand. The premium paid is 6,140, and it's a term for 21 years, and also an LIC Wealth Plus for 40,000 rupees and a Mediclaim from National Insurance. Please tell me if these are good plans or not, and what
they're all good plans. They're all good plans. They will give him a decent return, as good as most traditional plans in the market would provide him. Not less, not significantly more. In fact, I would say they were amongst the better traditional plans in the market. So he shouldn't be afraid from that perspective. He's already invested in it. Surrender charges will be very high. So I would never advise him to...
So continue with it.
Continue with it. From his national insurance policy, if he's got one, he should look at his sum assured. He should look at his income, see if that is sufficient. See if he's happy with the service quality. If he does want to make a change, portability is there. However, the plans are good. There is no problem. National Insurance is a great company, one of the largest companies in the sector, and they have good relationships with the hospitals. So I don't see a particular problem. He should stay with the plans. If he wants to increase his sum cover, sum assured, he can either go for a new plan or even take what you would call a super plan, which essentially what that means is if you have a 3 lakh rupee plan, you can enhance your cover to up to 10 lakhs. So the first 3 lakhs is taken by your primary plan.
Right.
And post that, you can go on to a secondary plan. There's a very good plan coming out in the next 2 weeks, which is going to cover this particular need of the consumer, where you can enhance your cover at a very low price and get all the benefits. So, look forward to that as well.
Right. We've got Kavi from Bangalore. He says, I've got a blood pressure and thyroid after 2 years of term policy. Do I need to inform the insurance company about it? Is it mandatory, he asks?
No, it is not. So as long as on the day that you took the insurance policy, you declared everything to the best of your knowledge and belief, and that was the true way. Whatever checks the insurance company had to do, the insurance company did, whether they wanted to do a medical, whether they, whatever they had to check, they checked. As long as the declaration was correct on the day you bought it, that was the day you entered into the contract. What changes? The insurance company has taken on the risk of changes to your life over time. So in case certain diseases develop or whatever happens, that is part of the risk the insurance company has taken on. So that's part of the contract. So no, you do not have to declare anything any further.
Right, we've got Poonam from Ambala. Go ahead, Poonam, with your question for Yashish.
Hi, I had applied for a term plan with Kotak for about 40 lakhs, which got rejected. Now I'm looking to apply to LIC for a term plan. And I wanted to know if there's any way that my medical records can be shared with LIC from Kotak. There's nothing wrong with me, but I wanted to know the exact process where I can apply to LIC for a policy, and I don't want to hide anything.
So, as you apply in your form, there is a question there. Have you ever been declined insurance in the past? So given that you have been declined insurance in the past, you would have to declare there. So the question of you hiding information does not arise, or the question of them having to go and check does not arise. So you would need to declare there that you had applied to Kotak Life and you were rejected by Kotak Life. And then LIC will, or any other insurance company will make up their decision post that knowledge. If they have to investigate further, they will do so. But if they think that's fine and your medicals are okay, they will go ahead. But it's important that you make that declaration. You should not hide that information in your declaration that you have been rejected. So if you look at the proposal form, it will have that detail in it.
Right, Yashish, thanks a lot. Now that's all the time that we have on this show of Policy Bazaar. But you can write your queries at ask@policybazaar.com. You can tweet us at policybazaar_in, and we'll see you in another show. Goodbye.